Well, this is Current Yield, Grant's interest rate observer of the air, and I am Jim Grant, and with me, as always, is the great Evan Lorenz, deputy editor of Grant's, and we have a guest today who shall be introduced in the fullness of time, in fact, the shortness of time. But Evan, before we get started with Spencer Jakab and his new book, The Revolution That Wasn't, I want to say two things. I want to say first that this broadcast is sponsored by Grant's Interest Rate Observer. We have, 6 subscriptions left after today. I think we have 6 or 8 available for purchase.
I'll have to check with Dell, but I think maybe 3 or 4 left at least.
Yeah, not many left. But first come, first serve, ladies and gentlemen. And the second thing, Evan and audience, I would like to point out is that there is an effort afoot, apparently a serious one, with the backing of institutions as estimable as the World Bank and the International Development Association, to improve the statistical apparatus of Somalia. Somali National Bureau of Statistics is going to become, in the words of the press release, a world-class statistical institution, heavily contributing to the development of Somalia. And what I want to ask you, Evan Lorenz, CFA, is why are they bothering? I mean, what do financial data have to do with the price of securities? I am just stumped. I mean,
not very much to judge by the last year, but I guess they're following the lead of other financial basket cases like the U.S., which is seeing 7.5% year-over-year increases in inflation.
Well, that's for the time being. I understand that this is something that will pass, much like actually kind of everything in life is a little bit transitory, I suppose. But wouldn't it be something if this didn't scoot along on the sell-side script, on the Fed script, and it annoyingly, persistently lingered, and the world was long bonds priced to yield about 1.4%. Wouldn't that be a state of affairs? Anyway, it's something. It's something, ladies and gentlemen, that we journalists hope for. It's the worse the better for us. Which brings me to our guest, Spencer Jakab, who was editor of the Heard on the Street department of the Wall Street Journal. Before that, he wrote Lex for the I forget the name of that newspaper. It's printed on a colorful newsprint.
I forget it too, Jim.
Yeah,
it's been a few years.
And before that, Spencer, for his sins, made a lot of money on the. As a financial professional for a very large bank in Europe, having interest in emerging markets, and got sick and tired of being rich and decided to go work as a mendicant in the financial journalism trade. So, Spencer, it is a pleasure to welcome you, and if virtually, it's just one of the annoying things about the present day, but Spencer is on a telephone someplace that he can't divulge, but he is with us nonetheless. So, Spencer, with that windy introduction, would you, I'm not quite finished with this introduction. I have an interest to declare, ladies and gentlemen. So among Spencer's employees, up until fairly recently, was Charles Grant, CFA. Charlie Grant, my number 2 son, worked for Heard on the Street, the Wall Street Journal, until he decided, he announced one day, Spencer, that he wanted to get a job, quote, on a real publication, whatever that meant. So he left Grant's and went to the Wall Street Journal, and he talked about his job. He loves his job, and I can say this now, and without fears of conveying some sort of embarrassing sycophancy on the part of Charlie Grant, but he loved working for you, Spencer. So anyway, with that out of the way, with this interest declared, Spencer, please tell us about the revolution that wasn't.
Well, thank you. I'll say one more word about your offspring. It was a pleasure. 6.5 years we were together, and now he's 100 feet away. Or once we get back to the newsroom full time, he'll be 100 feet away. And the apple does not fall far from the tree, or I guess the tree is not far from the apple. I don't know. He's wonderful to work with. But yes, on to my book. It is about GameStop mania, which was proclaimed as a revolution at the time, a revolution in terms of changing the power structure of Wall Street. Retail investors had suddenly sort of risen to the top of the food chain and figured out a new way to make money. And with journalists, we write the first draft of history, and we're all very excited for those first few days of the GameStop squeeze, when GameStop became the most traded stock on earth, and big hedge funds were bleeding billions of dollars, and people with names like Roaring Kitty were making tens of millions of dollars and showing screenshots of their accounts on Reddit. But that's not really what happened. What really happened is more of the same old thing. I mean, it is a great story. It's a crazy story, and there are a lot of unique twists to it for sure. But it wasn't a revolution in this financial sense, or in the sense of of changing the power structure.
So it was a little bit like the Egyptian Revolution of 2011.
Yes, well, I guess a different guy in charge, right? But back to the same thing. I mean, it was like a lot of revolutions that don't really change a lot, but it was. I mean, I admit that I was very excited about it at first, not because I thought it was a revolution, but because here was something completely different, and it is different, and the story is different in many ways from anything I'd ever seen. And I like you said, I work in emerging markets, and a year in emerging markets is like a dog year. You see, I haven't been doing this as long as you, but a year in emerging markets.
Nobody has.
But I mean, you see a lot of manias, panics, and crashes. You see a lot of crazy things, and and so I feel like that sort of doing it for about a decade, I did see a lot, and then in about 20 years of financial journalism too. But this was pretty crazy. But it wasn't a revolution, and it tells you a lot about how this new generation of, I don't even want to call them investors, but speculators, traders, is being milked by financial institutions. They're being milked in the same old way, but in many new and unique ways too.
That's one thing that really interested me. Before we spoke today, I was going on to Reddit, like Wall Street Bets, to see what people are saying about your book, and I went to like reviews on Amazon.com, and people are irate, but they're irate at you. They're not irate at the financial intermediaries that misled them. They're not mad at themselves for getting suckered in and losing money, but they've written reviews like, I'm halfway through this book, and if you're an ape, which is what they call themselves, then you're going to want to rip the pages out and tweet your anger towards the author. These people are mad at you, but not at anybody else, it seems.
Yeah, no, I'm all over Reddit, and lots of reviews. So it's interesting. Many of them didn't actually purchase the book, but they just they saw the title or they saw an interview or whatever. So they could at least buy the thing, right? I mean, before they leave their 1-star review. But yeah, no, they're angry at they feel like not only do they feel like they won, but the kind of postscript to the book is that this is continued. And so it's a nice thing when you write a book and you rush and you sort of every evening, weekend, vacation, falling asleep at the keyboard so you can get it out on the anniversary of the events. It's a very quick turnaround for a book. And I thought it's that will sort of be the apropos for people sort of reading it and looking at it, is that it'll be the 1-year anniversary. Otherwise, it'll be this sort of historical blip. But it's not, because they've tried to make lightning strike a second, third, fourth, fifth, sixth time, and they're still at it. And so there's a hard core of these people, a little bit like financial QAnon, where they believe that the real revolution hasn't happened and the real squeeze hasn't happened, and shares of GameStop and AMC and these other meme stocks are going to go up to hundreds of thousands of dollars and bankrupt, major institutions on Wall Street. So the fact that I'm pouring cold water on that, makes me a bad person.
Well, I would like to enter a review of this book, which is laudatory in the extreme, and I would like to compliment the prose style, which is silken, and the insights, which are numerous, and the wit, which is ever present. An example of the wit and wisdom in one single sentence is, quote, "They are the price of admission to those gaudy long-term returns." They, referring to bear markets, which is one of the, around here, Spencer, we talk about bear markets as a value restoration project. This idea that to earn long-term returns, you must suffer a bear market, not for our money, not frequently enough, but that's, cycles are a part of life and finance, and that is, as you say so well here, the price of admission. So how many stars can you get something on Amazon, Evan? Is it like 5 or something?
Not enough, but 5 is the limit.
Okay, Spencer, you get 6.
Okay, all right, yeah, because you need to pull the average up. Well, I appreciate that. And anyone else listening here, if you read it and you liked it on wherever you happen to purchase it, then always appreciated an actual review, even if it's 3 stars or 4 stars.
Let's talk about this. There's so many colorful characters in this who contribute to the very fine and indeed gripping narrative. And one of them is Keith Patrick Gill, CFA. AKA Roaring Kitty and Deep Bleep Value. Now, You refer to him in one place. He was also a former college track star. He's a considerable character. As his mother said, you quote his mother, I guess a journal reporter quote his mother saying, quote, Keith always liked money. So Keith harvests about the better part of $50 million. I guess have his gains gone long term yet? Let's call it $24 million after first cut of tax, but still it's a lot of money when you say it fast. And Keith appears in one picture. He's got a sweatband on, but he's also got wristbands. He's got a glass of beer nearby, but I understand the beer. That's helpful sometimes. But why the wristbands? Did you ever find that out?
I did not.
That's not my question.
I did not. Yeah, I did not. I couldn't really get into his style choices and stuff. But no, that's he often wore them. He'd have 4-hour YouTube videos. So he had 2 alter egos. He had one on Reddit, which began first, and then another on YouTube as Roaring Kitty. And there he would sip Belgian beers. He liked delirium tremens, and he'd go on and on. But the many interesting things about him, and that's why I trace the progression of the story through him, is that for 80 to 90% of the story, he was sort of ridiculed. If you go on social media, and he didn't flout his credentials. He didn't say who he was. I don't know if he would have been more credible or less credible if he had said that he's a CFA, which is a very difficult designation to get. But he would say like, oh, I doubled my money. People would say, well, sell. And he said, no, that's or the price has gone up. I'm sad about that because I wanted to accumulate more at a lower price. So his thinking was completely different to 99% of people who went on this message board, Wall Street Bets. And he was very cerebral, and he wrote in complete sentences, and he was respectful. And he just was pretty much, when he wasn't being ridiculed, he was just ignored. It's kind of a formula for how not to get attention on social media. And then he was later discovered, and all these posts that he had made were discovered, and then he became the most influential person in finance for a few days, basically.
Well, it happens to all of us for 3 or 4 minutes, but a span of 3 or 4 days is considerable. I love the way towards the end when there was a squeeze and there was a suspension of the buying opportunity in the meme stocks. Great scandal, and then there was a reaction to the scandal, and you quote the most oddly assorted cast of characters popping off in pure ignorance about what had happened, and the cast of characters includes. This is almost incredible, but here it is: Bernie Sanders, Ted Cruz, AOC, and my favorite, Donald Trump Jr. Where do these people come from?
Right, and they all sort of. I mean, and it's hard to say sometimes whether people got it wrong or just intentionally got it wrong. They understood what but saying pointing out what actually happened would be boring and make them look like part of the conspiracy.
I would also like to. I don't think we could find another topic that would actually probably unite people as diverse as Bernie Sanders and Don Trump Jr.
No, and this is 3 weeks after the Capitol riots. I mean, this was 8 days after Biden is inaugurated. It was a pretty, well, it still is, but it's a pretty fraught time politically. So to find an issue that they can all agree on, and then late night talk show hosts, sort of all laid into it as well. Maxine Waters and whatever, and so it was, everyone was in agreement on something bad happened.
Spencer,
I'd love. Sorry, I didn't mean to interrupt.
No, you go ahead, Evan.
So one thing that struck me, what you said at the beginning, is a lot of people are mad at you because they still expect one more squeeze to carry GameStop up to like an unknown high plateau. And that kind of reminded me of cargo cults, which was a term that came up in World War II because we were dropping so many crates of material on Pacific Islands that some of these tribes who were just hunter-gatherers would find these like giant crates full of like food, supplies, and weapons, and they developed kind of, religions around them. But here you have people who have developed kind of a religion around the stock market. Have you ever seen a cargo cult kind of applied to finance in this way before?
I mean, it's a little bit like that, right? And so there are whole elaborate theories. There are people who have hundreds of thousands of subscribers on YouTube who go on several times a week and talk about how it's coming. And it's called, if you want to go on social media, but hashtag MOASS, mother of all short squeezes. So they are expecting the big one to come. And it's a lot like, I mean, it keeps not happening, obviously, and it's not going to, but it's a bit like those cult leaders, I guess, who say that the world is going to end. That's what it seems more like to me.
Hey! That's a little close to home.
No, end, not hyperinflation end, Jim. The end, over.
Oh, I see.
And end of sort of life as we know it. And and so and then let's say at midnight on X day, and then it doesn't happen, and most of them kind of stick with it and even more fervently believe, and they can be convinced of this.
Hey, Spencer, drop what you're doing on October 18th and come to the Grants Conference. We've been doing these conferences for almost 40 years now, not quite, but we're having a conference on October 18th. It's the Plaza Hotel, and we are having a fine assortment of speakers, among whom is Tom Honig, president of the Kansas City Fed in the day, and he made his mark in Federal Reserve history by dissenting against the Bernanke-sponsored policy of quantitative easing. It would create a lot of mischief, and he was bold and persistent, and indeed, given the social pressures against speaking out, heroic. So Tom Honig is going to be there. Eddie Chancellor, who is soon will be out with a new book on interest rates called The Price of Time. It's a terrific book. I've read it in proof. He'll be speaking, and so will one of the very fine investors called Chris Bloomstrand, who runs Semper Augustus Investment Group. We wrote about Chris Bloomstrand in Grants not so long ago, and Evan and I were both deeply impressed by the way he went about his business. Yeah, so October 18th, come to the conference. Now, this whole crusade against the short interest, which short interest is pitiably thin. I don't know what it is statistically, but the people who do this for a living, the people you quote, and with Andrew Left, I think, figures as the figurehead. The figurehead's figure, yes, in this book they do. So Mr. Left got out of the business of commenting on his short ideas because he was hounded out, and he is not at all the worst sufferer on the skeptical or the bearish side of things because of the levitations of most of the past dozen years post the financial crisis. So now the Justice Department is finding evil doing among the short sellers, and there's this conspiracy anyway. It seems an odd group of people to be targeting.
It is and it isn't, right? Because if you go to Google right now and you try this at home, everybody, short sellers are, and then tell me what comes up. It's not a nice word. They're historically reviled, right? And you go back to the earliest stock markets in the 1600s, and there have been periods when short sellers have been punished and banned and whatever. And I think that, and then it's just strange especially for retail investors to have such animus towards them, because short sellers, first of all, short sellers were having a terrible time even before this. 2020 was one of the worst years ever for short selling, and the level of short interest in the market was extremely low. But the other thing is that short sellers, not that they're angels or whatever, but their existence is beneficial to the least experienced investors in particular. A, because they provide liquidity to the market, but B, because they make prices more correct. I mean, if there are only two default choices, you can buy a stock or not buy it because you think it's too expensive or risky or whatever, then that's leaving out a third option, which is betting against it, which is basically saying, I think this is actually too high and I'm going to make the opposite bet. And for a group of people that's not particularly well equipped to look at a company, maybe they see the chart going up and then they buy it for that reason, but not to do a deep dive or whatever. They need somebody out there who's a skeptic to take the opposite view so that the price is at least more correct. And there are many cases where so they're attacking them is sort of a strange, but they were very much made the enemy in this, and then bashing them was conflated with bashing Wall Street. But of course, Wall Street
short sellers are not short sellers are not Wall Street with a capital W and S. Short sellers are Evans, a small perverse cult, I think is what somebody. We had T-shirts made of that. Defiantly, we had T-shirts made of that slogan a while ago. In this book, there's so many great lines. One of it has to do with Spencer, when he's not writing books and not editing, heard on the street is a father of three, I think, right?
Yes,
Three,
yes,
three,
yes.
three apes, right? As
3 apes.
yeah, and you observe, Spencer, that each one of these, all of us walk around with a phone nearby, and perhaps in our hand, in our pocket, and this phone is the compendium of all the world's wisdom and knowledge, and yet one's apes cannot tell you what the Magna Carta is. So we have at our fingertips the world's entire store of wisdom and facts and pornography. Oh, and yes, that too, pornography, sure. But in the face of the availability of the wisdom of the world, people insist on making the same error, stepping on the same rakes. And I'm not glad that Jack Bogle is not around to read this book, but I think if he were around, it would break his heart. Because he tried throughout his life, and indeed he succeeded in a way that few have ever succeeded in applying a single, simple doctrine of investing and making an institution of it. So he did that, but my goodness, the defiance of those ideas, the insistence on acting against them, is what fills the page of this book, and I guess fills the message boards and the message boards, the term from the 1990s, but it fills the chat rooms and all that. And isn't it kind of crazy?
Well, it is, and I mean, and so you're always sort of taught that the four most dangerous words in investing are this time is different. This time is always the same. Human psychology changes very, very slowly. We're very poorly wired to be investors, which is why you have panics, and that's why you have manias. And so why would this be different? And I guess I would add a corollary to that, which is that yes, that the human psyche is the same, but the companies involved in this story have studied psychology very carefully, social psychology in particular, and so they understand how to push our buttons very, very well, and that has changed. So, you would have, I don't know, if you've gone back 40 years and told somebody there's this device you can carry in your hand, you'll have live, free stock tickers, all the news about a company, a bunch of people, experts to consult, and a bunch of amateurs to consult who will give you advice for free. You could trade for $0 and pull up a stock chart and do whatever. Do you think that people will be better investors? And they would have said, yes, of course, I would love to have a device like that. But it actually has made people worse investors in a way. I mean, it's cheaper to invest, which is one saving grace, but everything else is worse because you have so many influences on you, and just the being able to look all day will hurt you. And we know that activity is inversely correlated with returns for investors. I think study after study shows it. And if you open up Robinhood or one of its many imitators, the first thing that you'll see is what other people are buying and what's going up and what's going down. And that's not just useful information. It's put there to get you to trade. And Robinhood, they don't charge you anything, but they sell your trades. And so they're very interested in having you be as active as possible. And they've designed their app very, very well. And then social media. Well, social media, they don't write the messages, you write the messages, right? But if you write something crazy and inflammatory, especially on a subreddit like Wall Street Bets, it's going to be viral, and people are going to upvote it and read it and be engaged with it. And so,
let's not get too far away from the product here. The product is a revolution that wasn't. GameStop, Reddit, and the fleecing of small investors by Spencer Jakab. Okay, so I'm going to read a paragraph or part of a paragraph here to give you a taste of this fine book. Quote, the company had seen a turnover grow by 100% in its most recent quarter, and it had just bought its first Super Bowl ad. The millions of mostly young male users of its intuitive smartphone app can wager as little as a few bucks on a long shot and get the rush of making multiples of their money. They even get a free bet when they first sign up. Oops, sorry, that actually is a description of the online sports betting company DraftKings. Yeah, it's the same thing.
Yeah.
That's why it's so stupid that Somalia is wasting this money on improving the national statistics. They don't need better data. They need fewer smartphones.
Well, I mean, if you look at Robinhood and you look at DraftKings or FanDuel or whatever, they look very similar, and it's no accident, in my opinion, that they look very similar. I mean, they're frictionless, they're intuitive, the colors are enticing, the fonts are even oddly similar that they use.
Let me draw one. My dad would take me to Yankee Stadium. He was a Yankee fan, and annoyingly, I was a Dodger fan. But we went to Yankee Stadium in the 1950s. Was it 1850s? No, 1950s. Yep. And there was a sign right on the left field near the bullpen, Yankee bullpen, and it said, "No betting." Dad, what's that? Well, that's Judge Kennesaw Mountain Landis's decree after the Black Sox scandal. What was the Black Sox scandal? So he learned about the history of gambling and how it was verboten at baseball. So fast forward a few generations now, and you find that as the revolution that wasn't reminds you that betting on sports is endemic, very, very much like betting on stocks, both of bad odor from yesteryear, both now part of the mainstream of American culture. Betting on sports led to scandals that corrupted the game and almost broke the business model of Major League Baseball. Spencer, will there be a scandal of some kind that perhaps we're not even able to visualize now, having to do with what they call the gamification of investing or speculation, that will be similarly damaging to the business of capital allocation to its highest and most profitable uses?
It's an ongoing scandal. I mean, that's what I think is people miss about this, is that, you can sit back and you can tisk when people buy things on the basis of the greater fool theory, and you know that it's the greater fool theory rather, and you know that it's going to end badly, and you can not participate and wait for them to learn their lesson. But while they're learning their lesson, I mean, it distorts capital markets. And what's the reason for having capital markets? It's not the reason that we have gambling parlors, right? It's to allocate capital. So the next Apple is out there somewhere and trying to raise money, and maybe its story is not compelling. I mean, maybe it's not, maybe it's not capturing people's imagination who are using these apps, who are the people who sort of to pump up the values of these new shiny companies, and they're pumping up the values of other things that have, I don't know, fake hydrogen garbage trucks that are rolled downhill in a video to convince people that they work or what have you, right? So or buying dog coins. I mean, that's so not just that people. I mean, it's bad enough that these young people are going to have a bad experience when the scales fall from everyone's eyes, but also that capital markets are sort of not can't really function well, especially for the new companies that most need equity capital that can't just go to the bank.
Spencer, as you've noted, this is hardly the first retail mania. We had kind of the junk stock market in the late 1960s with the Nifty 50. We had the dot-com boom in the late 90s where Yahoo message boards were kind of like the key focus. And now we had the GameStop, stonkification of, investing. And it seems like each time it gets worse, and each time technology makes it worse. Have we reached a permanently high plateau of badness in terms of retails getting suckered in and losing money? Or is this kind of heralding that next time it'll be even more perverse and even worse than what we saw last year?
I don't know. I think that we've gotten pretty close to the bottom. I mean, because the difference this time, of course, the technology is the difference. Like I said before, I mean, in terms of
and interest rates are the difference too.
Right,
0% rates go with zero commissions, right?
Yes, yeah, and I think that plays a key part. I mean, zero. The fact that just psychologically, I mean, even if you're not doing a DCF calculation on paper or in your head, having interest rates at zero makes these lottery ticket like bets more appealing. I mean, it inflates the kind of the distant, uncertain payoff or the appeal of it, right? Rates, I guess they can go below zero. The cost of trading, they could pay you to trade. But the fact that we went from, going from 200 to 100 to 50 to 30 to 10 to 5 made trading much more easy. It made it much more accessible, and being able to do it through a smartphone and whatever made it much more accessible. But being able to do it so intuitively, so frictionlessly through a smartphone at a cost of zero, I think we really kind of crossed a Rubicon. So I don't know how much more. I guess I shouldn't say that, but I don't know how much further you can push it in terms of it just encouraging bad judgment, right? I mean, people don't have to think about it at all. If you open up a Robinhood account, if you're at a party with a friend and your friend says, "Hey, I have a Robinhood account and I think you should buy this crazy stock," you can open an account. They get a free share of stock for referring you. You get a free share of stock, which is just could be a very highly valued stock in some cases. So it could be more than the amount of money that you put in. You could be putting $50 or less into your account to open it, And even before the money hits your account, they give you the option of making your first trade. So they sort of front you the money because as long as it's on the way. So you don't even have that cooling off period of, well, it's going to take 2 or 3 days for the account to be active. So I don't know how much kind of more appealing you can get to sort of impulsive behavior than we already are.
Yeah, we sound as if this is not fun, and I think that one thing does come out of the book is just what a riot this all was. The people who were doing this, amusement, entertainment's no small part of this phenomenon, right? And certainly Jack Bogle had the angels on his side when he talked about the long term and about he was he was advocating hodling. But my goodness, how dull it sounded, and how virtuous it sounded, and how bad this sounds now, and how much fun it is. So we are a little bit. We're preaching that people ought to get on the wagon, and that what they really want is just 1 or 2 or 3 IPAs a day. Is that too much to have?
Well, yeah. I think that's fine. I mean, obviously everything in moderation, but it is fun for this generation, and so so many things have to happen in conjunction just to lay the groundwork for this. And so I keep getting asked again and again, do you think that this will happen again? I don't think that this episode can really repeat again, because I think, first of all, Wall Street is on its guard. I mean, the big hedge funds, most of them now, monitor social media or pay somebody to monitor social media for them. And by monitor, I mean, they have computer programs that can read it more quickly than humans can read it and reach some conclusion, and sort of red lights will go off at their hedge fund's headquarters if one of their positions is affected. But also because so many things had to happen in conjunction, including the pandemic. You had young people stuck at home, bored, young men especially had rushed into sports gambling on their phones, and all of a sudden there were no sports to bet on. And then here was a thing that was briefly much more profitable to bet on, because if you got into the stock market at the bottom in March 2020, then over the next year 96% of stocks rose. So you really felt like a genius no matter what you bought, and especially if you bought the things that serious people in suits were telling you were a little bit too risky, you did very, very well.
Yeah.
So I mean, it told you that this sort of professional advice was worse than worthless. It told you that investing is easy, and success is a very poor teacher.
Yeah, I liked the somewhere in this fine book there was a quote from I guess a Robin Hood ad, from Super Bowl ad, was that investors, good investors, aren't made. You were born, or you were born a good investor, was the essence of it. When in fact one is born with every compelling instinct to buy high and sell low. That's the way we're wired. Yes, you were. You don't become a good investor. You were born one. That was a Robin Hood ad, as quoted in this fine book. So, Evan, I always forget the name. I should not forget the name of the Federal Reserve governor, now teaching at Harvard, when commenting on 2011, 2012. When there were intimations that low interest rates and QE were fostering moral hazard and excesses and things like private equity. He, soon to be named, because everyone's going to remember the name.
Jeremy Stein, I think.
Jeremy Stein, yeah. Said apropos of interest rates, or he was talking about monetary policy, but he meant interest rates, that, quote, they get in all the cracks, close quote. And I have on my desk a press clipping from the New York Post about 6 months ago, and in it, Spencer and Evan, the author of the piece, is asserting on his or her own authority. It was a kind of a New York Post flash that the Federal Reserve has no control over NFTs, non-fungible tokens, or such things, and that rising interest rates, if they did rise, would have no effect on the price of NFTs. And I think that conceit is pretty well distributed in the market, and people say, yeah, well, the Fed's got nothing, rates, bonds. But it's going to be an interesting thing to watch the potential collision between that misconception and the unbudgeable fact of rising cost of capital, perhaps in the back of a persistent rate of inflation. That could, once again, I envy you, Spencer. It's going to be such great copy. How can you even imagine being out of the office during this fine period?
I know, Jim. I'm going to go out on a limb here and guess that you're not the proud owner of a JPEG of an ape.
Huh? I'm going to argue that NFTs argue that inflation is much higher than we otherwise reported. 5 years ago, clip art was free. You can go into Microsoft Word and actually pull up whatever you want to. And now people are paying millions of dollars for stuff that I could have gotten for free, 3 or 4 years ago.
That's inflation. Spencer, thank you for being on this Grant's Interest Rate Observer podcast, one. And thank you for writing the revolution that wasn't GameStop, Reddit, and the fleecing of small investors, two. Thank you for both. And also for shepherding Charlie Grant through 6.5 years of very productive work at the Wall Street Journal. Thanks for all of that.
Well, you're very welcome on all those counts. Thanks so much for having me.
Well, that's it from Current Yield, ladies and gentlemen. Thank you so much for listening. Spencer, thank you for being here once more, and we will talk to you again soon on Current Yield, Grant's Interest Rate Observer of the Air.